To quote, "The Chancellor will certainly overshoot the borrowing target for the current financial year," Peter Spencer, Ernst & Young Intern Club. "In the medium term, the escalation of public borrowing is of great concern. Over the next couple of years, there is going to be a significant pressure being placed on capital markets," he said. Mr. Shaw said public borrowing could be in the region of £150 billion next year, which, in the longer term, to quote, "would be unsustainable." The index of leading US economic indicators fell in February for the third time in 5 months, reflecting worsening conditions that spurred the Federal Reserve to say yesterday it will buy Treasury securities. The Conference Board's gauge dropped 0.4%, less than forecast, after increasing 0.1% in January, according to the New York-based group's report today. The index points to the direction of the economy over the next 3 to 6 months. A credit freeze at the center of the worst financial crisis in 7 decades, the highest unemployment rate since 1983, and slumps in manufacturing and housing are forecasting policymakers to accelerate efforts to stabilize the economy. And in our final story before the commercial break, the world economy is set to shrink by between 0.5% and 1% in 2009. The first global contraction in 60 years. In its gloomiest forecast yet, the IMF says that developed countries will suffer deep recession. The global economy body said the prolonged financial crisis has battered global economic activity beyond what was previously anticipated. Just 2 months ago, the IMF predicted world output would increase by 0.5%. In the event of further delays in implementing comprehensive policies to stabilize financial conditions, the recession will be deeper and more prolonged. But in its report drawn up for the G20 group of finance ministers, the IMF now says that the whole world economy will shrink and predicts that the advanced economies will suffer a decline in output of between 3 and 3.5% in 2009 and barely grow in 2010, with growth of between 0 and 0.5%. And it warns that the economic conditions could still deteriorate further if the banking crisis was not tackled head-on by the governments around the world. And now we'll go to a commercial break and a word from our sponsors. overhaul. Willis Chief Executive Joe Plumeri has offered staff cash incentives to cut their working hours in a bid to trim costs. According to sources inside the company, Mr. Plumeri told staff at the Willis building in London that he was looking for volunteers to work 4 days a week for less pay. It is understood that an internal email had gone around Willis to the various employees in February informing them of the cash incentives, and Mr. Plumeri has now offered staff cash incentives in return for blocks of unpaid leave. One option involves staff taking a month's sabbatical, and in return they can earn 30% of the salary for that period. Willis told Reinsurance magazine, "We are offering our associates the option to take some unpaid leave and or partly paid sabbaticals. This fits with our policy to move towards a more flexible working structure and benefit structures. It also gives us another tool that allows us to manage our costs as we, like other professional financial service firms, navigate these times, which are difficult times of economic turmoil and uncertainty. This scheme is not compulsory and is managed completely in conjunction with team leaders to ensure client service is never compromised. It has been extremely well received by our associates." Also in London, the Financial Services Authority, the FSA, which regulates the insurance and reinsurance industry, has fined Blackburn insurance broker Asprey £21,000 sterling for failing in control of its appointed representatives, or ARs, and for misleading its clients and the FSA. Asprey, which specializes in managing insurance